Afternoon, everybody. My name is Jonathan McCash, EVP of Wholesale Sales here at Sierra Pacific. We are thrilled to welcome everyone to this call today and appreciate you taking time out of your busy schedule to learn how to master CalHFA. CalHFA has been helping borrowers achieve homeownership for over 50 years. As one of the largest bond products in the country, CalHFA has a multitude of options available for conventional, FHA, VA, and USDA financing, flexible guidelines, and competitive pricing to help your borrowers achieve homeownership. On this call today, we're going to really be discussing the importance of CalHFA in your book of business and how it can help you grow. As we know today, homeownership in America and in California remains tremendously challenged. Having an affordable option for your California borrowers like CalHFA is critical for your borrower's success and to help you expand your referral base. Just this past week, CalHFA has introduced a series of new offerings that provides borrowers significant savings and puts homeownership for many within reach. Sierra Pacific, the largest, and I'll repeat that, the largest wholesale CalHFA lender in the US, and the first to market with these products, is here to support the opportunity ahead and help your borrowers achieve that critical homeownership. Whether you're new to CalHFA or have been originating CalHFA loans for years, we are experts here in CalHFA, and we can help you navigate the program to ensure the product fits your borrower's needs. So joining us today, before we get started here, on the call today, two of my favorite people here at Sierra Pacific and the most knowledgeable CalHFA experts we have here at Sierra. We have both Jennifer Martinez and Brina Hertzler. And before I pass the call over them, I just wanted to go through some just housekeeping items really quick, if we could. So a couple important details on the call today. The call is muted. So just know that we want to hear from you. We want you to enter your questions into the Q&A box at the bottom of your screen. So if you navigate to the Q&A box, you'll be able to answer questions. You'll be able to ask questions. And our panelists here, both Jen and Brina, will be able to answer your questions in real time from the Zoom window. And again, our team of CalHFA experts here at Sierra will help walk you through the CalHFA product, the changes that were just implemented here this past Monday, and answer any questions you have around the product. So without further ado, let me introduce you to Brina Hertzler.
Thank you so much, John. I also want to thank Jen for joining me. Jen is going to be really handling the Q&A and making sure that all of your questions get answered quickly. So with that, we will go ahead and get into CalHFA. Okay, most of you know that CalHFA is a state agency, but I really just also want to put this on here because I wanted you to know that John did allude to Sierra Pacific being the #1 wholesaler, and we don't take that lightly. CalHFA is a small portion of what Sierra does. Obviously, it's only in California. We're a national lender, and so while it's a small portion of our business, we do it better than any other lender. Like John said, we've been doing it longer than any other lender. And even the flexibility that we allow, which you'll see in terms of when you lock and how quickly we close these, is bar none better at Sierra Pacific. And so no one does these like Sierra Pacific. That's right there. You can see that we close these loans in under 21 days. We've definitely closed them in 17 days. I still recommend kind of making sure that your escrow is not at necessarily 17 days, but you know that we close these quicker than anybody else. If you're new to CalHFA, I just want you to know kind of how this works, right? And so a lot of people would think do we go to Sierra's website? Is it like a combination? And no, it's basically CalHFA's first lien that they actually offer to people that do not want down payment assistance. They have their own lien which you're going to get into the rate sheet, so you're going to see that. But they have their own lien, and then they offer down payment and closing cost assistant liens that you can add as a second or a third on various programs. And so that's how that works. Here is the website for you to grab their program guides, their forms. To be real with you, I really Google, when I'm looking at the rates, I'll Google CalHFA rates. I'll Google certain things because it pulls up the guides a little bit quicker for me than going through their website. To each his own, but I just want to let you know that's kind of how I do it. And we can go ahead and move to the next. Thank you so much. So when we go through this, I want you to kind of remember that whether we're doing VA or USDA or FHA or conventional, you need to know that whatever you know about FHA, or conventional, we're going to follow those same guidelines. So for instance, if you're doing a student loan and we're trying to decide between FHA with CalHFA or Fannie Mae, because when you do a conventional loan with Sierra Pacific and CalHFA, it's only Fannie. So they don't offer Freddie guides, it's only Fannie. So when you're trying to decide between these two, you don't have to wonder like, oh, does CalHFA have its own special student loan guideline calculation? No, like if you can go FHA, you're probably going to go FHA because it's going to offer a 0.5% on that calculation versus Fannie being 1%. But just know that while we go through these guidelines, most of the guidelines that reflected in each agency's guidelines are going to apply, but these are kind of like the overlays, if you will, that CalHFA has for their program. All right, let's start with the number one, first-time homebuyers only. So this does change a little bit from agency guidelines. So a first-time homebuyer is defined as a borrower who has not had ownership interest in any principal residence or resided in the home owned by a spouse during the previous 3 years. This is different, like I said, than agency. I want to point out one thing here. It says has not had any owner ownership in a principal residence. So I've mentioned before, if you have two brothers and they own a second home in Tahoe, but neither of them own a primary residence, they would be still qualified as first-time home buyers. Do know, though, that if there's any additional mortgages on your borrower, they will make sure that you document 36 months, 3 full years of renting, and they will not take less than 3 years. We've had it happen. So do know that whether you have, let's say, a granddaughter that's on title for her grandmother's home, and now she wants to go buy her own home, she will have to document 3 years of renting to be able to qualify as a first-time home buyer. And Sierra Pacific is delegated on the underwriting on these things and closing these loans. But when it goes to CalHFA, it's really to stamp pretty much number one. Number one is one of the biggest things they're stamping, as well as checking the first-time home buyer training. So this is a big one for them. Just know it. The second thing that's really big for CalHFA is that all borrowers on the loan must occupy the property. There isn't any non-occupant co-borrowers, but they also, non-borrowing spouse cannot be on title at closing or added after closing. This is a big one. This is different than how we do it today. So do know that they cannot be added on title or after. Income limits do apply to this. We're going to get into those. I'm going to show you what they are. They're very generous, as well as the max loan amounts. They're going to follow the county loan limits. Do know also that conforming and high balance are both available. I want you to kind of start thinking about this high balance, because as Jennifer and I were speaking last night, it's just about kind of just what we were noticing is some of the highlights of CalHFA. High balance is something we've kind of struggled with in the market in terms of rates. And so I want you to look at sometimes offering this CalHFA for high balance when you need possibly a better price. So we'll get into that. The minimum FICO for FHA, VA, USDA, all govies is going to be 640. And then conventionally, you're going to need a 680 FICO. The minimum FICO for a 80% AMI income limit borrower, which is known as low income with CalHFA, is 660. So if you have a borrower, conventionally, they're going to, not FHA, but conventionally, they're going to do a CalHFA, the minimum FICO is 660. There's also a reduction in the MI. And so if you have a low income borrower, reach out to your AE and make sure that you're on the right path. Because sometimes you may want to compare the low income to the FHA. And like I said, we're going to look at the rate sheet, so you're going to be able to see the difference in rates. And so that is something I just want to make sure we point out. When it comes to DTI, there's a threshold. So 700 FICO is that threshold. If you are 700 plus, your DTI can go up to 50%. If you're under that 700 threshold, you're going to be with the 45 max DTI. All manufactured homes are also at the 45 max DTI. So we stated that they have to be first-time home buyers. They also require a couple things to protect the home buyer. They require a first-time home buyer training. This is required prior to doc. You're going to do it online, eHome America. It's $99. Only one borrower has to do it. But you do want to make sure that your borrower starts this, so that it is 8 hours. So you want to get them going. The other thing that CalHFA does to protect the borrower is they mandate a 1-year home warranty. So make sure that you're letting your client know and you're getting that home warranty, because they will require that when they do that final stamp. Okay, so I kind of talked about how we're going to follow the normal guidelines for these. So there is DU approve eligible findings. So you do have to have an approval for these. And then they will go ahead, like I said. And so if it's, whatever the DU says for income, what you need for income, you're going to go ahead and follow that. In terms of properties, these are the properties that you're going to be able to do this with. Single family residence, 1 unit, single family residence with an ADU, condos. If you have not sent a condo to Sierra Pacific, I highly recommend it. Sierra has the very best condo department in the entire industry. They are masters at condos, and none of us want to be masters at condos. So it's so good to have a team in your corner that is helping you with those condos. Manufactured homes, like I said, is going to be a 45 max DTI and a 660 FICO for the FHA, and then 680 for Fannie Mae. Who is eligible for these? U.S. citizens, permanent or qualified non-permanent resident aliens, EAD, including DACA. Lakeview is the master servicer on CalHFA loans, and they have their own guidelines. And so if you have a borrower that you're not sure if they qualify, reach out to your account executive. They will go ahead and get you basically a matrix of who qualifies for which programs. But I just highly recommend that you reach out to your AE when you are having a borrower that is not necessarily just a U.S. citizen. Okay, so there's this new program that you guys have heard about, hopefully by now, and it kind of gets a little bit confusing with what's this new program. And so I just want to remind you, when you go to a rate sheet, which we're going to do, you're not going to see My Home on the rate sheet. So I just want to break down what My Home is. We already talked that CalHFA has a first lien, and then they're going to have a down payment assistance second. That down payment assistance second, so on a conventional, we would have a 97% CalHFA first lien and a 3% down payment assistance second. It's silent. That second is called My Home. If we were going FHA, you would have a 96.5% first with a silent 3.5% second. So that is the way that you're structuring that 100% financing with the first and the second. As you can see, CalHFA sets their income limits per county. You can see here on the right-hand side, the limits are very generous. If you have a low income, they do not qualify this. This is the standard income. And again, most people qualify. I do want to point out this, make sure that you're paying attention to this next one, because this guideline changed in the last year and a half. All income received by borrowers must be used in income calculation unless there is not continuance. What this means is that in times past, we would use qualifying income. Whatever they were qualifying at, that was the income that had to apply here to the limits. CalHFA changed that guideline, and now you have to use all income received by the borrowers. So if you have a husband and the wife is not going on the loan because of possibly her FICO or any type of different thing, obviously her income does not have to be counted because she's not on the loan. But if there was a borrower that was on the loan that had, say, less than 2 years of overtime, well, you could go ahead and not apply that overtime because they don't have a 2-year continuance. It doesn't meet guidelines to use the overtime, so you would not use the overtime. So that is kind of the new way of CalHFA, is using the total income, whether it's bonus, overtime, commission of the borrowers. I spoke about how that second lien covers 3 or 3.5%. That can be down payment and or closing costs. Obviously, most people use it for down payment. But when you're looking at a USDA or a VA, USDA and VA, as we all know, are 100% financing. And so this My Home is going to be a 3%, and it can be applied towards the closing costs. This is a killer way to do CalHFA. So I know that neither of these programs are as common, obviously, as conventional or FHA, but being able to use that 3% as an additional for closing costs is really beneficial when you're doing a VA and USDA. So both of the loans are a 30-year. The second is silent, which means there's no payment required, and they only have to pay it back when they refinance or they sell the property. So it's not forgivable. We mentioned that here because we want you to know that there have been forgivable programs in the past. My Home is, like I said, when you borrow that money, you will pay it back at time of refinance or purchase. And then do know that borrowers can contribute their own funds. So like you were going conventional, you would have normally like a 97% first with a 3% silent second. Well, if your client had an additional 2% and they were like, oh, I want to put 2% more down because I want to be able to get better MI, that is absolutely an option. If they wanted to put, another 10% down, they can do that. There's no real caps on that. And so that is something different than other CalHFAs in the past, but do know they can contribute their own funds or gifts towards down payment and closing costs. When we do the ZIP, I do want you to know that the ZIP is the third lien that is typically available with these. So thank you so much. So in times past, you always did a ZIP, right? You would do a first, a second, and a third. And the reason being is that these are borrower paid loans. So when you have, let's say, a 97% conventional first with a 3% silent second, that still, your borrower still has to pay for your compensation as well as their closing costs. Obviously, this can be paid by like themselves, a gift, or a seller concession. We know that conventionally a seller concession can be 3% and FHA can have a 6%. So the ZIP used to be a thing that was just always this, you do a first and a second and a third, and the ZIP is offered in a 2 or 3%. So you can see that you'd have your 100% financing, and then you would add the ZIP, and typically that ZIP would be like a 2% or a 3%, and it would go towards the loan offers compensation, because this is the real struggle with the CalHFA, is that it's borrower paid, and so they have to pay that fee. It's always going to be less than them paying the 3.5% down payment for FHA. So in total cash to close, when we're structuring these loans, this is always going to be less, but it's still 2 or 2.25, whatever it is that you're charging, that the borrower has to come in with. And that is why the ZIP was so popular. The next program that we're going to get into is going to be, it's going to mirror the ZIP. So we can go ahead and go to that next program, but I'm kind of wanting you to see that this MyAccess really equals the ZIP. The reason that the ZIP is not that popular these days is that the market rate has made the ZIP so expensive that it's really not affordable for borrowers to be able to do the ZIP or to qualify with the ZIP. And so most often borrowers will just do a first and a second. That would be known as the CalHFA first with the My Home second. It gets kind of funky because when you add a third lien, CalHFA changes the name to CalPLUS. So when you see the word CalPLUS, you know that it's not just a first and second, it's a first, second, and third. And so that can be CalPLUS with ZIP, or as you can see here, it can be CalPLUS with Access. So I want you to just, like, this is the new program right here. And the whole reason that they brought on the Access is that instead of using the market rates, they are now using mortgage bond rates. And the hope was that the mortgage bond would offer better pricing than the current market. So Lakeview would offer the ZIP at the current market, and it would be, gosh, 7 1/8 for a 2% ZIP. Whereas when we look at the rates today, we're going to see that the Access, specifically on FHA, is a much better price for the borrower that needs that closing cost assistance. Okay, we're going to talk about that again because that is the new part, but I just kind of wanted to be able to show you that you've always got the first, the down payment assistance second, and then you have the option for these thirds, and these thirds are the ZIP and the Access. Okay, so we got that. We're going to go to here to CalReady. So CalReady, whole new thing, is exactly the same as a first and second with My Home. So these new programs are not anything really new guidelines and things to follow. The CalReady and the CalPLUS Access are the CalReady equals My Home and CalPLUS equals ZIP. CalReady, you don't actually have to take the down payment assistance if you don't want. If you just want to use the first, which I will talk to you about why that when we look at the rate sheet, why you would ever do that and not use the down payment assistance. But the CalReady, you can use it. It's a taxable bond program, same FICO, same DTI, same first-time home buyer requirements. Everything is the same, but you can pair it with the My Home. Basically, it kind of creates the new My Home. It'll say CalReady, but you can add the My Home. If you do or do not add that My Home second, the rate does not change. And so it's kind of a funny thing, but it's usually in the mortgage bonds to be able to kind of create that better pricing. The biggest thing I think you guys are going to really use is the CalPLUS Access, conventional and FHA. When we look at the rate sheet, you're going to see that right now the conventional isn't like some huge breathtaker, right? I mean, the pricing's about the same, but when we look at the FHA, I think this is going to be really favorable for these borrowers to be able to utilize an additional 2.5% second. So that's what it is. When we go back to like that, we're not going to move to the slide before, but when we go back to that My Home with a ZIP, the ZIP is offered in a 2 or 3%. The Access, and it's only for closing costs. The Access, the new program using mortgage bonds, is 2.5%, and it can be used for down payment or closing costs, right? So that is a big difference, and that kind of allows you a little bit more to structure these loans. So we have the last piece here where it's MyAccess program. And the reality is that MyAccess is going to be utilized as, it's always going to say CalPLUS MyAccess, but we wanted you to know what that MyAccess is. It is the third mortgage. It's exactly like the ZIP. It just is better pricing today, and there's going to be days where there's going to be better pricing on the industry street as well as the mortgage bonds. So we're going to go into that, but I just want you to know ZIP equals MyAccess, and CalReady is going to be basically a first or a first and a second. All right, that feels like a lot. I hope you guys gather that. This rate sheet is what I really want to train you on, because I feel like when we look at the rate sheet, we can kind of go over all of, I'm going to use my cursor so we can kind of talk together. So when you look at a CalHFA rate sheet, this section here is going to be on the top, and then this is going to be below it. Obviously for ease, we stack them next to each other. We're going to start over here. And so I kind of want to talk to you about these programs, why you would use certain ones, and I just want to kind of go through it. So this first program here, which is CalHFA Conventional, you can see that it says no CalHFA DPA. I'm not joking. For years, I would be like, why would anybody do a CalHFA Conventional, no DPA? Like, nice try. But the reality is that you can see that the CalHFA rate sheet is very simple. There is no pricing hits. There's no discount, no credit, none of the things that are in these rates. You will see right here, high balance loan limit fees, which we're going to talk about. But in terms of the regular pricing, there is nothing additional that you are going to be pricing it in. It's very simple. So if you were doing a conventional with no DPA, it would be 6.5%. I've had people in times past when the rate was a little bit lower actually use this for, let's say, a condo borrower that possibly didn't have the best FICO, because there is no hits. So they would be able to utilize this rate. You don't have to be a first-time home buyer. So they would utilize this rate. The reality is most people do not ever use this, but I wanted to just teach you what it is in case it ever does help one of your borrowers. On the conventional side, you can see there is a standard rate lock on the left-hand side, and then you can see that low income rate that we talked about. When you look at the standard rate lock, if we're utilizing the max 97% LTV, this will always have about a 35% MI coverage. When your borrower qualifies with that 80%, so when I talk about that 80%, it's really that home ready, you know, the 80% AMI. When we look at this is going to be cut in half. So this is going to be at 18% MI coverage. So forever, if you ever have a borrower that is going to qualify at this low income, surely you're going to go ahead and take advantage of it. Some days this rate may be 6 1/8 when this is 6 5/8, right? Today it's pretty close, so it's not as big of a deal, but I do want you to know that because the rates are going to change, and CalHFA's rates, sometimes you'll kind of come on here into the rate sheet and you'll be like, thought it was going to be different. It doesn't always follow exactly like the market, you know? So I want you just to know what these two are. When we come to the second one, this is the most common rate today, the 6.625. What this represents is CalHFA Conventional with CalHFA DPA. This is 100% financing. 6.625 today is 100% financing. And then your borrower would have to come in with your compensation, because it's borrower paid, as well as their closing costs. This represents the exact same thing. The only difference here is it's got a couple little lower guidelines, like the FICO we talked about, and then the MI. And then when we move down, you can see, remember I talked about when you have a first and second, and then you add a third, they change the name to CalPLUS. So now you have CalPLUS Conventional with 2% ZIP. The first, obviously, the rate on these is going to be offered. So if you have a first and second or first, second, and third, the rate is going to be 7.375 for the first. The second is always silent. The second follows a 1% fee simple interest rate that accrues usually annually. It's better price to do annually, and it's very minimal. Whereas the ZIP is a zero interest. If you borrow 12 grand, you're paying 12 grand back at time of refinance or sell. And so that is what this program was. So if we were doing the CalPLUS Conventional, we'd have a 97% conventional CalHFA first with a 3% silent second for down payment, and we'd have 2% additional for closing costs. And this would be the rate offered. If you needed more income, more assets for closing costs, that 3%, this would be the same, 97% with a 3% silent second and 3% third lien, giving you 3% for closing cost assistance. Again, if you were using a seller concession in combination with any of these, the seller concession max would be 3%. Dream for All is still on the rate sheet. Dream for All is not being funded this year and likely probably next year, because these kind of self-fund the next program. And as you know, that's a newer program. And so we are still getting vouchers, however, because people were on the wait list. And so we're still getting vouchers. So that is why this is still on the rate sheet. You can see on here that the stars, whether it's the CalReady Conventional, CalPLUS Access, or over here on the FHA, these are the new programs. So that's why they're starred, is to highlight what you wouldn't have seen last week and what you are seeing today. So CalReady conventional, this represents basically the same as this right here. So you have a 6.625. And so if you were doing a first and a second, it would be 6.625. Interesting that the mortgage bond on this program is actually higher. So if you were just doing 100% simple financing, like basically no closing cost assistance, obviously you wouldn't do CalReady. You would do CalHFA conventional with a CalHFA DPA. I do agree that it should say CalReady conventional with CalHFA DPA here. The reason being is that you don't have to take the down payment assistance if you don't want, but this does represent the same 100% financing. Here is the new program, CalPLUS Access. Again, the 7 1/8 is a 2.5% third lien that can go towards down payment or closing costs. And when we come up here to look at the 2% or the 3% thirds, you can see that it's a much better price than even the 2%. The difference being, again, this is 2.5, and you can use it towards down payment or closing costs. Whereas the ZIP up here at the 2% can only be used for closing costs. So that's the conventional side of it. As we move over to the FHA and government side, you can see that there is no low income rates locks. There's nothing. It's only the standard. And so you will often have people, like if they had a low income, you're kind of comparing it. FHA has pretty much been blowing conventional out of the water a lot more recently. I mean, obviously the FHA rate is lower in general across the board in our industry, but in terms of these zips and things like that, you can see that if you were doing 100% financing and you were looking to decide if you were going conventional or FHA, you would be comparing this FHA 6.375 with, again, the conventional 6.625 here, or the CalReady. Both through these three options, these being the conventional and the FHA, are the same thing. They're 100% financing. So today the rate is obviously a lot lower. The other thing that really kind of lends itself to more FHA is that although you still have the upfront MIP with FHA, the MI factor has been greatly reduced. So now the MI factor on this is a 0.55, whereas this is, like I said, is like a 35% coverage. So it's usually a lot higher with conventional than FHA. So you do want to price out the MIs and compare those, but I just want to note that while we're here together to just let you know that that's kind of the full picture, because you're going to have to structure this and figure out which is the lowest payment for your client, because typically that's what they're really being driven by. This CalPLUS FHA with 2% interest program, 7 1/8, you can see this is what's always been there. One thing to note that when you look at that 3%, it says NA. What this means is that Lakeview is not comfortable pricing, like posting the pricing for that 3%, and it's not available. I've had times where people, the 3% was not available when they submitted the file, and then they're waiting for it to come the entire transaction. I do not recommend that. If it's not available, you can always know in the back of your mind like that it might be available, but do not structure it with a 3% if it's not available. I do have a better option that we're going to get into, and it's really exciting for these borrowers that need additional closing cost assistance, and that is going to be the CalPLUS Access FHA. So when we look at this, the CalPLUS Access FHA is 6.75 today. So 100% financing is 6.375, right? And if they need closing cost assistance, which most people do, they will get an additional 2.5% for only 6.750. This is a really good deal compared to the fact that last week, all we had was this option, a 7 1/8, and it only gave you 2%, and it was a lot higher. So I would think that the majority of people that are doing CalHFA are going to probably be coming under this CalPLUS Access FHA. I just restructured one literally about 30 minutes before the call. They were going to go ahead and lock it, and I was like, whoa, 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 don't lock it here. Lock it on this. So we just did a quick COC. So if you have a loan in the pipeline that you haven't locked yet, you can just do a quick COC and have your account executives team, the account manager, go ahead and process that and then get you locked in on the CalPLUS Access. So that's the new program here with these. So again, the 3% is not available. I do want to let you know that CalReady FHA is also available. So this is the same program. Remember, we talked about the CalReady. This is the same program here, that 6.375 as upstairs at the CalHFA up here at 6.375. Today, they're exactly the same. And so there's no reason to pick one or the other. You would just, I mean, unless you were doing a high balance, which I'll show you here in a second, you would just pick this one either way. But there's no difference, so it doesn't really matter. Just know that the whole reason that they created these other programs was to have better pricing. So the guidelines are the same, everything's the same. There's no real benefit aside from the fact that the pricing is going to be different and that it's a 2.5% third versus a 2 or 3%. And it can go towards down payment versus just closing costs. When we look at the VA and the USDA, I love these. I feel like these are incredible opportunities, specifically for our vets, and obviously people in the rural areas with the USDA, but these are already 100%, the financing of these is 100%. So you kind of wonder like, okay, well, is it just like 100% financing at 6.375? No, this CalHFA VA at 6.375 offers the My Home as well. So you are going to get 6.375 on a borrower paid loan. You're also going to get an additional 3%, which is the My Home for VA or USDA, and that can be used for closing costs or down payment. So I would imagine that most people would use this as a 6.375 for the closing cost assistance when you get the My Home, and then both for the USDA. One thing to note is that we all know that VA has that 1% rule. And so the compensation would be 1% for the originator, unless Sierra Pacific has the solution. If the seller is paying an additional amount, like let's say the seller is paying for the closing costs and they're willing to pay for your origination, you can make over that 1% even on a VA borrower paid. This is just, I mean, if you've got a seller that's giving some concessions, this is an incredible deal. Obviously, we all know that even on VA, they offer 4% seller concession, and it can even help pay down borrower's debt. This is a great solution for a first-time home buyer. I just wanted to make sure that we get that pointed out because this is, it's a great deal. Same with USDA. You can go 100%. I just closed 2 of these last month where they're getting 6.375, 100% financing, and then they're getting an additional 3% for closing costs or down payment, but most people use it for closing costs. And so that is the deal on this. The one thing I want to talk about is see this little font down here that says high balance loan limit fee. One of the things I think we all struggle right now with is high balance pricing. And so Jen and I were talking last night where we were like, wait a minute. Okay, so we've got over here on the conventional, you've got like 0.69, and then you're like, whoa, we're getting over here and it's like 1.248, and then, whoa, 1.844, and this is a discount point, right? So they have to pay this to get this rate. And then we were just kind of going down, we're like, whoa, look at this. CalPLUS Access only has a 0.5 point. And we're like, oh my gosh, this one only has a 0.416. And then we came down here to CalReady. I'm sorry, to CalPLUS Access FHA. And Jen was like, so wait a minute, we could do let's call it a $900,000 loan, and they're going to get a 3.5% silent second, and then they're going to get another 2.5% in closing costs assistance for a 0.5 point discount at a 6.75 interest rate. Like that's the kind of way you want to start thinking about CalHFA. I've had clients send borrowers on a CalHFA loan versus a standard loan because of the pricing benefits. Because again, especially there's no condo hits, there's no FICO LTV. And so as you kind of start to structure these deals, you want to really realize the possibilities of how this can be solutions for the current market that we're in. So this is the rate sheet. It really was important to me that we went over it because I know sometimes you guys get on here like, what's CalPLUS? And I'm like, well, when they add the third lien, they change the name to CalPLUS. And so that is the rate sheet. Okay, one of the best parts about sending loans to Sierra Pacific, aside from your account executive, aside from the fact that our team is just incredibly fast, our system is easy to work on, is the fact that this is just one loan required for submission, and Sierra Pacific really does all of the rest for you. So you're not submitting like a first, a second, and a third lien. You're just submitting the one loan. We're going to issue all the initial disclosures. You basically, CD is issued as soon as the loan is approved, locked, and the appraisal is reviewed by underwriting. Just a quick side note, this is one of the only programs that we require the appraisal to be reviewed to get the CD out. So just make it a practice, whether it's a CalHFA, whether it's a conventional, a USDA, make it a practice that whenever your file is approved, as long as it's locked, that you are requesting your CD so that you're just in the habit of doing it. Obviously on a CalHFA, you can see that the underwriter will have to approve the appraisal, but it's a good practice to get into because we're trying to close loans as quickly as possible. And since we don't need, even on a refinance or purchase, we don't need that appraisal to be reviewed. Just get in the practice of doing that. CD is approved by broker, issued before issuing to a borrower. So whether it's an LE or a CD, if you really want to see that ahead of time before it goes to the client, you can always reach out to your account manager and ask he or her to go ahead and have you have the ability to obviously review that before we go forward. Okay, so to reserve the lock, basically the lock is how you're going to reserve the funds for CalHFA. One of the greatest things about Sierra Pacific is the only thing we require for you to go ahead and lock is for the property to be in contract. A lot of times I've had files where the file is approved and maybe they're submitting PTDs and they're like, hey, when can I lock? And I'm like, oh gosh, you could have locked the day that it was, gotten to contract. So as soon as you're in contract, you're able to lock. You basically, what's going to happen is either yourself or your processor is going to create a loan in Sierra system. It takes about 15 seconds, and then they're going to import the loan. It takes about 15 minutes to do the whole process of doing the 1003, re-importing the credit, and adding the additional liens into the system. And it's basically just one little line that you're letting us know, hey, we're going to do the My Home, and we're going to do the Access, and you're letting us know what those are. Once that's done, like I said, that's a total 15, 20 minutes. You can go ahead and lock right in the system. If you're familiar with our website, you know that there's a menu that's on the left-hand side. That's basically when you're in the menu of your loan, and it'll say rate lock on there, and you'll just go ahead and lock it in. It's super, super easy. You do want to make sure that you lock before 2 p.m. because CalHFA closes early. And so we need to make sure that we check that it meets guidelines. You've got, your credit's been pulled, your AOS is approved eligible. And so we confirm those things, and then we go ahead and lock it in. This is super easy because you don't have to go directly to CalHFA. Sierra, again, will do all of this these extra items for you. The lock is good for 30 days. And so you're going to lock it in at the rate for the day and reserve those funds. If you need any extensions, CalHFA offers 15-day extensions for an eighth in fee, and the max extensions is 30 days. If you've got new construction, go ahead and reach out to your account executive because there is an additional 30 days that are allowed when you've got new construction. But for the most part, you can do up to 30 days of extensions, and you can see it would only be a quarter to get that extra 30 days. On the right-hand side here, you can see what the fees are. Sierra Pacific's admin underwriting fee is $10.95. We've got a couple other fees here, and then you can see that if you've got the first and the second, that would be a $500 for the two. And then if you do the additional zip or the access, it would be an additional 50%. So really, it's only $550 in fees to be able to do this. A lot of people don't understand that it is borrower paid, and I've mentioned this probably about 4 times today because I want to make sure that you do know that it's borrower paid origination. The way that we operate with this is that we will do a max of your lender paid comp agreement with Sierra or 2 1/4, whichever is less. So if your max agreement with Sierra Pacific is 2%, you're going to make 2%. If it's 2.5, you're going to make 2 1/4. So that is how that's allowed. Broker processing fees are allowed. Third-party processing fees allowed. We've never seen an issue with that, so you should be good to go. Okay, so you guys know that Sierra Pacific does CalHFA better than anyone else in the industry, and we do appreciate being CalHFA's #1 wholesale lender. But we do want you to know this is not all we do. I said in the beginning that it's a small portion of what we do. And I want to say that one of the reasons, like when people come to you like, hey, well, why do people send loans to you? What's so special about Sierra Pacific? Each of your account executives is on the call right now. And I would say that Sierra Pacific has the best account executives. They know this product so well, but they know all of our products really well. So I would say that at the very top is just like basically the person that's guiding you through Sierra Pacific, and their team is just so good. When you look at our reviews, you always see like that the team was so fast and everybody was pulling from the same rope, and it just felt like we were an extension of your team. And that is exactly how we want you to feel. I also really get a lot of positive feedback about the fact that the underwriters are not only qualified and excellent underwriters, but they are available. So when you actually upload a loan, just so you know, in our broker portal, which is Express Loan, you actually have access to your full entire team, their phone numbers, their emails. This is all by design. We do not have any black holes at Sierra Pacific. We always want you to be able to get a hold of who you need to be able to get a hold of. And that's why we actually make it easy to put that information into your loan portal so that you do not have to be searching for who to contact. It's all there. The underwriter is always willing to directly communicate with you on your loan. This is so efficient. You can always contact your account executive, but for most of my clients, they go directly to the underwriter, and they love the fact that they can just say, hey, on this condition, Did you not like what was in there? Or did you need a page 6? It makes it so efficient. The technology, when I work with processors, hands down, people love our platform. And I'll say that a lot of lenders will say like, oh yeah, we have a new platform. Ours is proprietary. It won 2024 Tech 100 Mortgage Award for the ability to work quickly in it. It's got quick pricing engine that allows you forward locking without registration. This is something that a lot of originators don't know, is that when you want to lock a loan with us, you can go ahead and lock it in and then come and put the application the next day. You don't have to have the credit pulled in our system. You can lock directly in there. Obviously, we now allow self-disclosures and express loan. Our system really, we built really kind of how we operate, but also our platform to fit a bunch of different needs, right? Some of you want to operate everything on your own. You want to do basically use Sierra Pacific for underwriting. Some of you want to have Sierra Pacific do everything. And so we offer that flexibility. So if you want to do self-serve disclosures and get them out in a second, you can do that. If you want our team to do them, you can do that. Condo specialists. You heard me talk about condo specialists. Our condo director is award-winning. She is so smart when it comes to condos. She recently came up to us and said, hey, I know we're doing really great on the FHA and conventional condos, but I think we should do VA condos too. And so it's just like the difference of like her total ownership in her team and the way that she operates. This has been so beneficial to a lot of my originators, because sometimes nobody cares if you've got like a condo, like let's say you have FHA, or, you know, you're doing a single unit approval. Nobody cares that, you know, you need a 21-day close and you got to get a single unit approval on an FHA. The highest and best way for you to get those quick closes on condos is to pre-flight your condos with your account executive and he or her team. The way that you do this is you'll just say like, hey, I've got Park Lanes over here in, you know, Sacramento, California. Can you find out if this is already FHA approved? The condo department will research it and they'll say, hey, it's not FHA approved, but we can do a single unit approval on this, or it's Fannie Mae approved. Here's what you're going to need. And it makes it so quick, because let's say you did need that single unit approval. You can get working on that single unit approval before you've even submitted the file to us. By the time the underwriter gets it to approve your loan, the condo's approved. It makes it so much quicker. So do take advantage of that with us. Non-QM offerings. I hope a lot of you were able to attend our training recently that we did on non-QM. We're offering obviously alt doc, which is bank statements, P&Ls, asset depletion, 1099s, personal 12 and 24-month bank statements. We are seeing a lot of this. I think you guys are appreciating not only the fact that our turn times are so quick, but also the pricing on these. We do have an incentive pricing going right now, but I will tell you, Sierra is all in on this non-QM. And I know that like it's not necessarily your mainstream, but it's a really nice program for investors just utilizing income in a different way. So whether it's DSCR and you're utilizing the income from the property versus the borrower's income, the nice thing is that we've expanded our portfolio to a 0.75 DSCR ratio. And so that's been really beneficial in helping some of those investors on their DSCR. The number one loan that I'm seeing a lot, if it's not conventional FHA, is the Wage Earner Express. You guys are loving the Wage Earner Express because not only does it offer an improved pricing versus just a standard conventional, but the turn time is, if we're usually 1 to 2 days, it's a 24 hours turn time. But let's say that the market gets better and we go to 2 to 3 days, it's still going to be a 24-hour turn time. But this is a really popular program. You do want to make sure that you submit a written VOE with this program, but basically, when you see that Wage Earner Express on the pricing, it just means that you're not using Schedule E or Schedule C income to qualify. You're using W-2 income. Fast Track HELOC is definitely a great solution when cash solves your problems. And so we're seeing a lot more HELOCs. Basically, these close within 5 days or less, 2% broker comp, and you can do quick pay via ACH. But this is something when you're structuring loans with your clients. And I actually had one where I was talking to an originator. I was actually making dinner at 6:30 and he called urgently. And I was like, why don't you just do a HELOC? You can just get, you know, your cash in like 5-6 days. And he was like, oh, a HELOC. So I know you guys all know about HELOCs, but just remembering that when you need cash quick, a HELOC is a great opportunity, whether it's to buy another property or whatever you're doing. That's another thing that we're doing great. And it's been really popular. Government loan experts, FHA, VA, USDA streamlines. Our minimum FICO goes down to a 620. We do manual underwrites on our government loans. We also do, as you heard me say when I was talking about the CalHFA, we do manufactured. It's another piece we do. I also want you to know that here's the go-to resource for state bond programs when you're trying to find out what else does Sierra Pacific do in the state bond down payment assistance programs. we are obviously the leader in California, but what's interesting is the Pacific Northwest, when they were looking at opening up their bond programs to the TPO wholesale space, they actually reached out to California and they said, hey, we're looking at offering this to a TPO lender. Who would you recommend? And California told Oregon and Washington, hands down, Sierra Pacific. And that's actually how we got Oregon and Washington. We also have Florida and Texas. So some of these programs mandate that you live in the state or you live within 50 miles of it or your office is located. I'm actually looking at Oregon and Washington when I talk about that, as well as Florida. Florida has even more criteria, whereas Texas is a little bit more flexible like California. So reach out to your county executive if you're licensed in those other states and you're wondering if you can do the state bond down payment assistance programs. I am so grateful that you guys joined with us. I want to be able to open it up to any Q&A that we haven't answered. So we will go ahead and do that. When you pull out your camera, I want to let you just talk you through what these are. So the CalHFA lock request, you used to have a form, right? We would come here and we'd say, hey, scan this for the CalHFA lock request form. Forms are out, QR codes are in, and so this is just the job aid on how to lock it online. I'm telling you, it's very, very easy. You probably don't need the job aid, but if you want to pop your camera open and get that real quick, you can do so. If you are not approved with us and somebody invited you to this webinar, go ahead and scan that and we'll get you approved. And then if you're wondering like, hey, I just want to pop around your site and just kind of see what it is, the last one is our broker portal express loan, which was the website that I was talking about that people just absolutely love. All right, let me see here. I'm going to come in here and see if there's any Q&A. Jen, are we doing pretty good on here?
We are. We have a really good question
Okay.
from Danielle. I am new to CalHFA loans. If we do the loan with Sierra Pacific, do you handle all of the CalHFA paperwork or do we have to do this and bring it to you?
Okay, great question. I think that this is, I don't know, Danielle, if you are recently from retail or not, but one of the nice things in wholesale is that when people were coming from a retail environment, retail, meaning that you work for the bank, you would have to do all this directly with CalHFA. So you would have to lock it directly with them. You would have to submit it with them. The nice thing with the wholesale space is that we will handle everything with CalHFA. So you're going to submit one loan to us. You're going to add that it has a second or possibly a third. But other than that, when it goes to lock, you're just going to request in our website. We're going to handle it directly with CalHFA. When it needs to go to CalHFA for that stamp that I was talking about, we will send it to them. A lot of people will say like, hey, well, how long is CalHFA taking these days? Typically it's still about 1 to 2 days. And so that's when I was talking about these being able to close so quickly. Sierra Pacific is so quick. I mean, we've got usually our turn times around 1 to 2 days, 24 hours for PTDs, and then 0 to 24 on all closing docs and funding. I mean, this team is so good. And so when you've got CalHFA at like 1 to 2 days, you can see that doing a 21-day or less close is pretty simple. Anything else, Jen?
I do. This is a really good question. So if a
Yeah.
buyer is married in California after he closes with a CalHFA product, may he add his spouse to title when he marries?
Sadly not. CalHFA does not allow you to add anyone to title. And it is a point of contention for some people because obviously of this point. And so sadly, they are not able to add a spouse after they close.
So here's a condo question. So
Okay.
for those that are not on the approved list, can we still do those for as a single unit or are they always approved?
No, so when we were talking about the condo department, you will reach out, let's say we're doing FHA, well, you would reach out and say like, hey, is this FHA approved? And the condo team will say like, it's not FHA approved, but it's eligible to do a single unit approval. If you're used to the word spot approval and single unit approvals are the same thing. But the condo team will basically direct you on, hey, it's not FHA approved or it is FHA approved and like, here's all you need. And so that's why you can get a single approval if they're not approved. But the condo team is really going to direct you on that. Do you have you're living in condo land, Jen. Do you have anything else to say on that one?
No, I mean, I would honestly just always reach out to your account executive and kind of send them the HOA name, you know, the address, and then we can work with our condo team to double check to make sure it's not on the naughty list.
Mm-hmm.
And or if it's been rejected by FHA, and then we can go from there.
Yeah. And do know that we do non-warrantable condos in the alt doc space and in the non-QM. And so when you've got one of those, you can always reach out to your county executive and see if it would qualify for, bank statements or 1099, things like that. Let's see. Have we answered David's condo question here?
That was
Jen, are you saving all the condo questions for me?
I am.
Okay, so David, you guys, Jen lives in San Diego. She is the condo queen. But David asked, can your condo people help guide an HOA to get their complex approved? Not a single unit, but the whole complex. It's not for a current escrow. It's planning for, and then it gets cut off there. Let me see if I can just move
For the
this.
future betterment of
Yeah.
the community.
It's funny you should ask, David. That was actually something that Jen came back with a story where Jen was doing a CalHFA training in Southern California, and an originator stood up and said, I just have to tell you guys, their condo team not only was able, like the single unit wasn't the issue, they got the whole condo approved for me. And then I was the one that got that whole condo approved. And so the condo team would really be able to tell us, because I don't want to say that on every project we can do that, but you definitely want to reach out to your account executive and find out, you know, if that would be eligible. But I will tell you, like, when I talk about that condo team being the best, it's not just their knowledge, but I've been in situations where the originator is stuck, right? And the HOA is just not helping and they can't get a hold of them. And the condo team will go, you know what, we're going to call the HOA and see if we can work this out. And I mean, the originator's like, nobody would do that. I can't believe that they called them. And it solves the problem, right? And so that's what I mean. I mean, Sierra Pacific has 5 pillars, and that kind of that vibe of really going to the next level and taking ownership and doing whatever we can is really part of our culture. And so you can see that specifically even in the condo department. All right. Jen, do you want to take us ASIMS? What is the max loan and limit for your fast track HELOC? I think it's 250.
I believe it's 250, yes.
Yeah, the 250. For condos that are not in the, oh, we did that one. Do you have a bank statement non-QM program, Nancy? Yes, we do. We have an incredible bank statement program. And like when I said that we went all in, we hired we call him the Rain Man of non-QM, and we found him from competition and we hired him and we love him. And he is so phenomenal at terms of structuring different types of non-QM, whether it's alt doc or DSCR, and is really kind of helping us all get around our head around that stuff. If you want to do a non-QM training, whether it's for your office or for real estate agents, reach out to your account executive. Will is based in Dallas, Texas, but he's always happy to do those via Zoom. And I will tell you that I've done a couple, and he is so helpful in terms of not just like what Sierra Pacific has to offer, but also just how to like market to those loans. Because I do know that all of us are looking for more loans, and you don't market to the DSCR clientele like you do with realtors and traditional financing. Hi, Jason. Is Sierra Pacific able to do bank statement loans on investment properties in unlicensed states just like DSCR too? Sadly not. You have to be licensed in that state. DSCR is the only one that you can do it in the unlicensed states. And so what Jason's talking about is that when you do a DSCR and you want to do a DSCR in, gosh, what's a state? I'm trying to think of the 7 states that are not on that list, but we offer licensing in 42 states. And so you can definitely check with your account executive what the 8 states that are not licensed. Ohio, I know, is one of them. But they're basically most of the nation. You can do loans in those other states. I know Maryland is one that I don't think they allow it, but check with your AE because you can likely do DSCR in states that you're not licensed in, because it's, like I said, there's 42 states that you can do it with. What question do we have next? Hi, Brian. Investment HELOC. No, sadly, it's first and second homes. Let's see. Jennifer, did CalHFA previously allow an occupying co-borrower that owns a home and only one borrower needs to be a first-time home buyer? No, Lisa, they did not allow that. But on the Dream for All, they did allow first-time generational home buyer. And I think that might be what we're thinking. I mean, maybe not. Maybe you're thinking of something in the past, but they do allow all borrowers have to be occupying and living in the property. Yep. Do you have an asset depletion calculator? Hi, Belinda. Jen, do we have an asset depletion calculator?
We don't, but I would reach out to your account executive. I mean,
Yeah.
typically we follow, I mean, it just depends. So are we trying to talk, are we speaking non-QM or are we speaking agency? So there's,
I think she's speaking non-QM asset depletion. Yeah.
I mean, I would send it to your account executive and then we can work with our non-QM underwriters to see if we can come up with a figure for you.
It's another good question just to kind of bring up is, you know, when you've got bank statement and you're like, hey, what income are you guys going to use? Your account executive, whether it's bank statement, whether it's self-employed and you need a little help, what we typically want is like, hey, what are you seeing? You're going to send us your calculations for your income, as well as all the income documentation. We are working with different technology pieces to be able to offer this on the alt doc space. So you will see that very soon. Sierra is very technology forward. It's really important to us to be able to utilize the technology that is available and that is becoming available to make your life easier. And so you will see that coming out, but anytime that you need income help, you're going to reach out to your account executive and you're going to say like, hey, can you help me figure out, you know, if this income that I'm looking at is the income that your underwriter is going to use.
I think we have time for one more question, Brina.
Yeah, go ahead. Do you want to pick it?
Does CalHFA allow owner-occupied duplexes?
Sadly not. They only allow single family residents. They do allow a single family residence with an ADU. And so when you're looking at utilizing income from an ADU, I would recommend going FHA because as we talked about, CalHFA doesn't do Fannie and Freddie, they only do Fannie. And Freddie and FHA are a little bit more similar in terms of how they look at utilizing ADU income, whereas Fannie is, she's just too hard on us on that ADU income. So I would definitely go FHA on that one. Yeah. Jen, anything else?
I don't think so. All the questions that are in the Q&A, we'll get back to you and, you know, answer as best as we can. And we just would like to say thank you for spending the hour with us and learning about this awesome new product and about Sierra Pacific. You know, we're here to help you. We're a full service lender. We really care about you. So we want you to get more referrals with those agents.
Yeah, you're going to love Sierra Pacific, guys. So if you haven't sent us a loan, definitely utilize an opportunity with CalHFA, but I would not miss out on those other opportunities that we discussed because I'm telling you, if you look at your AE's LinkedIn profile, you'll probably see that a lot of originators are really loving working with Sierra Pacific and we're no longer, you know, the best kept secret. So thanks so much for joining. Have a wonderful day.
Thank you. Bye, guys.
Bye.